What if everything we thought we knew about this bull market is dangerously wrong? August 22nd was supposed to be a turning point. Federal Reserve Chair Jerome Powell finally hinted at a potential rate cut in September. Within minutes, all three major U.S. stock index futures surged. Investor sentiment turned euphoric if the bull market had been given a fresh lease on life. But here's the uncomfortable truth we need to confront right now. The risk of buying into U.S. equities at this moment may be higher than it was before the stock market crash of 1929, higher even than before. The global financial meltdown of 2008 sound unbelievable? It's not fear-mongering, it's what the numbers are telling us. Today's market valuation levels have now surpassed 98.2% of all moments in the last 150 years. In other words, in only 1.8% of U.S. market history has the market been more expensive than it is today. The last time we approached this level, it was in 2000, right before the dot-com bubble burst, and the Nasdaq plummeted 78%. Countless investors, including seasoned professionals, lost everything. What's different and even more alarming this time is that multiple indicators are flashing warnings simultaneously. The Buffett Indicator is at 217%. The PE-10 ratio, sitting at 37.4. Nearly every valuation model is signaling red. If you've been thinking, this time is different, the data we're about to share may profoundly challenge that belief. So ask yourself, are we headed for another historic collapse? More importantly, what can smart investors do now to protect their wealth? Stick with us until the end of this report. We're not just uncovering today's market risks. We're mapping out how to survive, even thrive through what's coming next. Before we begin, do you think the U.S. stock market is in a bubble? Yes or no? Drop your thoughts in the comments below. Let's start with a question many newer investors might ask. What exactly is the PE-10 ratio? Why should you pay attention right now? The PE-10 ratio, also called the cyclically adjusted price-to-earnings ratio, or CAPE ratio, was developed by Nobel Prize-winning economist Robert Shiller, like the traditional PE that measures price relative to the most recent year's earnings. The PE-10 takes the average earnings over the last 10 years, adjusted for inflation. Why does this matter? Because company earnings fluctuate wildly during boom and bust years. A single year of exceptional profit or major losses can severely distort a basic PE ratio. Using a 10-year span helps even out those peaks and troughs, capturing a full economic cycle, recessions, growth periods, and everything in between. Here's a simple example. Let's say a stock trades at $100. Over the past decade, its inflation-adjusted annual average earnings were $5. That gives it a PE-10 of 20. Meaning, based on long-term performance, it would take 20 years to recoup your investment. So what's the problem with today's PE-10? Right now, the U.S. market sits at a shocking 37.4. Essentially, you'd need 37.4 years of average earnings to break even on $1 invested today. That's more than just a red flag, it's quantitative proof the market is extremely inflated. Here's where it gets even more unsettling. A PE-10 of 37.4 means we're in the 98.2 ND percentile of all market valuations going back over 150 years. In only 1.8% of the time has the market been pricier than what we're looking at today. Let's examine those few ominous precursors. First, 1929. Just before the infamous crash, the PE-10 was at 25.2. Back then, investors were euphoric about booming industrial technology, but within weeks the market imploded. The Dow plunged 89% over 3 years. That collapse triggered a decade-long Great Depression that decimated household wealth and global confidence. Second, the year 2000. The PE-10 hit 44.2, still the highest in history. Everyone thought the internet would transform every aspect of commerce forever. It did, but not before the Nasdaq lost 78%, wiping out trillions in wealth. Many tech companies, once darlings of Wall Street, vanished overnight. Third, 2007, right before the financial crisis, PE-10 stood at 27.4. Real estate was red hot. Financial engineering created a facade of stability. But when the bubble popped, the S&P 500 dropped 57%, and the world faced its worst financial crisis in generations. So where are we now? Today's 37.4 is higher than both the pre-crash of 1929 and the pre-crisis level in 2007. Only the dot-com insanity surpasses it. And there's a crucial difference back then. The overvaluation was largely confined to tech. Today, it's system-wide. Valuations are soaring across nearly every industry. Let's pull back and look at the longer-term implications. Statistically, the higher the PE10 ratio, the lower the market's returns over the following decade. There's a strong negative correlation. History suggests that expected returns over the next 10 years may be extremely weak or even negative. This doesn't mean crashes happen overnight. But it does tell us that paying this much now means investors are getting very little in return for the risk they're taking. Now, markets always revert to mean valuations. And there are only two ways they can get there. Either a dramatic price drop or a massive surge in corporate earnings. But given the current economic headwinds slowing productivity, high interest rates, and persistent inflation, it's hard to see the scenario where earnings rise fast enough to justify these valuations. The far likelier path, significant price reset. If you're still with us, it's clear you're not here for surface-level commentary. At Epoch Report, we decode the data and connect the dots. If this level of insight matters to you, click to follow our channel and turn on bell notifications. In just 10 minutes a day, we'll help you stay ahead of financial trends instead of being blindsided by them. Let's look at another famous metric backed by Warren Buffett himself. This is the so-called Buffett Indicator, the ratio of total U.S. stock market capitalization to GDP. Right now, it sits at 217%. To put that in perspective, Buffett himself has said that anything between 75% to 90% is within a normal range. Once it hits 120%, the market can be considered overvalued. And 200%, that's playing with fire. We've blown past that threshold. The current reading not only exceeds the cautionary zone, it's 68% above its historical trend. Roughly equivalent to 2.2 standard deviations, an extreme statistically rare deviation. While this indicator doesn't predict exact crash dates, it reinforces a fundamental truth. When stock prices race far ahead of economic output, something eventually has to give. It's not just the data. Look at investor behavior specifically, the smart money. Warren Buffett's firm, Berkshire Hathaway, now holds the largest cash position in its history, over $347 billion. Just a year ago, it was $167 billion. That's a $180 billion increase in liquidity. And here's the kicker. He's even scaled back holdings in Apple, Berkshire's biggest equity stake. What does that tell us? Even the world's greatest value investor isn't finding enough attractive opportunities in today's market. It's waiting patiently for a better entry point. Then there's Howard Marks, legendary founder of Oaktree Capital and a longtime investment thinker our team at Epoch Report closely follows. He's highlighted 4 critical warning signs. 1. Market sentiment has swung to extreme, unsustainable optimism. 2. Risk awareness has all but vanished. Investors are acting as if downturns are impossible. 3. A dangerous disconnect between price and fundamental value is unfolding. And 4. The market always cycles. When it veers too far into euphoria, pessimism is never far behind. His message is clear. In moments of irrational exuberance, caution and patience can be your sharpest tools. Beyond valuations, several macroeconomic threats further complicate the outlook. Interest rates remain stubbornly high, with 10-year Treasury yields above 4%. Even traditional valuation models adjusted for interest indicate the stock market is still overpriced. Then there's inflation. Despite recent progress, producer price inflation remains sticky, limiting the Fed's ability to aggressively cut rates. Persistent real interest rates are beginning to weigh on economic momentum. Geopolitical uncertainty is another looming threat. While ceasefire hopes can create short bursts of optimism, once the news cycle moves on, markets face the risk of rally fatigue. And let's not overlook crypto, where digital assets once isolated from Wall Street are now woven into mainstream portfolios via ETFs, pensions, and even corporate balance sheets. Crypto bubbles, when they burst, won't stay contained. The systemic shock could be far-reaching. So what's the play in a market like this? Step 1. Revisit asset allocation. Leverage is your enemy when valuations are stretched, so avoid margin trading. Build a cash buffer that can be deployed when price is correct. Step 2. Picky stock selection. Growth stocks with inflated valuations tend to collapse hardest. Concentrate on undervalued companies with strong fundamentals and overlooked growth potential. Global equities, particularly in Hong Kong, Chinese tech, and selective shares still offer opportunities at far more attractive valuations, but you need a process. At Epoch Report, we recommend a systematic 5-stage stock selection approach, born from over 30 years of cross-market research. It's practical, repeatable, and built to catch what many investors miss. Step 3. Tighten risk control. Set stop-loss limits on holdings that have rallied sharply. And build a watch list of high-quality companies that are too expensive now, but could become bargains fast in a downturn. Finally, prepare emotionally. Don't try to time the top. Nobody knows the exact peak. But when markets fall, those who stay command have a plan, often emerge the strongest. The evidence is mounting. U.S. markets are valued at extremes by historical standards, by fundamental metrics, and by the behavior of elite investors. PE10 is at the 98.2 percentile. The Buffett Indicator sits at 217%. And cash balances are surging among the world's most cautious, successful investors. Does this mean a crash is guaranteed tomorrow? But waiting for that moment is missing the point. History reveals that markets this stretched inevitably return to fair value. The process is rarely painless. Those who prepare, corrections can be treacherous and wildly profitable. As Buffett himself said, "Be fearful when others are greedy, and greedy when others are fearful." Today, the signs point to caution being not just wise but essential. I want to hear your views. Do you think the current U.S. stock market is a ticking time bomb, or is the fear overblown? Yes or no? Drop your take in the comments. We read every one. If this brought you clarity, don't just like, subscribe, and hit the bell. In markets like these, timing and insight matter more than ever. And the best part of the Epoch Report? Just 10 minutes a day, we help you spot the trends shaping tomorrow before most people even know they've begun. We'll see you in the next one. Stay sharp.